Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on the measurement of non-financial assets held for social benefit. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations. This session begins by looking at what we mean by the measurement of non-financial assets held for social benefit. Next, we will consider the main issues that NPOs face when measuring these assets. We will then look at how these issues are currently addressed in the existing accounting standards, beginning with the international standards, before looking at how some national standard setters have addressed NPO-specific issues. Finally, we will look at the alternative treatments identified in the consultation paper and how you can share your voice and respond on this and other NPO financial reporting issues. So what do we mean by the measurement of non-financial assets held for social benefit? NPOs use a wide range of assets in delivering services. Examples include community facilities, warehouses, and even hospital buildings and equipment. The measurement of these assets in the non-profit sector may be more difficult than in the commercial sector. This is because NPOs are far more likely to hold these assets for social benefit and their service potential for the organisation, rather than any economic or financial return. Measurement difficulties can arise for the following reasons. NPOs may find it difficult to record assets that have been donated. While NPOs may be readily able to measure an asset on acquisition if purchased or constructed itself, both recognition and measurement can be more challenging where the asset has been donated. Where an asset is given to an NPO for a time-limited period or for a particular task or project, can also sometimes be difficult to determine whether an NPO has rights to the benefit that an asset provides. This can lead to measurement complexities. Determining the boundary between assets held for operational purposes and assets held for investment purposes can be difficult. For example, if an NPO rents out housing assets, this could be for social benefit or it could be to generate financial returns. It depends on the objectives that an NPO has for the use of that specific asset. It may be important for stakeholders to understand the assets that are being used by the NPO to provide its services and, in particular, the operating capacity of these assets. Donors and other funders may also be interested in understanding about assets to which they have contributed and how effectively their donations and other funds have been used. Assets might generate some cash inflows, even where they are primarily held for social and public benefit purposes. For example, an NPO may run a community centre which offers classes for which it receives nominal fees from users. Although the community centre is generating some cash flows, the NPO's objectives are such that it is doing so for social purposes. And finally, the value to an NPO of an asset may reduce if the assets become damaged or deteriorate. This is because the level of service provided by the asset reduces. This is known as impairment, and it may be difficult to measure impairments where an NPO is using assets for their service potential rather than to maximise economic returns. The difficulties in measuring non-financial assets held for social benefit can be summarised in one of four categories. These are 1. Initial measurement. Assets purchased or constructed are expected to be recognised at historical cost on initial recognition. An estimate of the value of donated assets also needs to be derived. All assets will remain recognised on the balance sheet, whether or not they are cash generating. 2. Subsequent measurement. NPOs need to decide how to continue measuring the asset once it has been initially recognised. Historical cost can be used as a basis of subsequent measurement, and it spreads the initial cost of an asset over its useful life to the entity. But measuring some assets using historical cost may not reflect their usefulness to an NPO. Alternatively, NPOs can use a valuation basis if this is more appropriate. Measuring assets using a revaluation model may, however, be costly, and assets that might be measured at highest and best use could far exceed their operational value to an NPO. 3. Impairment. An annual impairment review is needed where there are indicators of impairment irrespective of whether the cost or revaluation model is used. And finally, 4. Disclosure. It may be important to donors and other stakeholders to understand the operational capacity of assets. Because there are different asset measurement bases, NPOs will need to explain the measurement base it is using. This is particularly so when disposing of assets that might have a different sales value to help users of the financial reports. We will now examine each of these categories in turn in more detail. Examining first financial reporting challenges surrounding initial measurement, assets purchased or constructed are expected to be recognised at historical cost on initial recognition and are likely to be relatively easy to initially measure because the cost to the NPO will be known. When an NPO acquires property, plant and equipment, it needs to be included as an asset on the balance sheet, whether or not it generates revenue. Where assets are donated, an estimate of their value also needs to be derived. There can be challenges to determine initial value when there has been no cost to an NPO to acquire the asset. Establishing an appropriate value may be particularly challenging where an asset is donated if it provides either more capacity or is of a higher specification than is needed by an NPO. All assets will remain recognised on the balance sheet even where they are not cash generating, assuming they have service potential. Service potential includes the use made by an NPO of an asset to deliver its objectives for the organisation's purposes. Once an asset has been recognised, entities need to decide how to continue measuring the asset. International accounting standards require that asset values are updated at regular intervals, known as subsequent measurement. This can be either at historical cost or at a revalued amount. This is an important decision that needs to reflect the information needs of an NPO and its stakeholders. Historical cost as a basis of subsequent measurement spreads the initial cost of an asset over its useful life to the entity. Historical cost may be attractive for use in subsequent measurement due to its ease of use and understandability for users. Measuring some assets using historical cost may not, however, reflect their usefulness to an NPO because assets are usually held by NPOs to provide services and not principally for the income they generate or the price for which they can be sold. A valuation that reflects the value of the assets to the business, for example the cost of replacing the output of an asset, may therefore be more useful. If the value of an asset increases because of greater potential service provision, this would not be recognised in historical cost measurements, but will be in a valuation model. Measuring assets using a revaluation model may, however, be costly. NPOs would need to maintain asset valuations so that they are materially accurate at the reporting date, which may require substantial resource input from NPO staff and valuation experts. This may be cost prohibitive, particularly for smaller NPOs. Under a revaluation model, assets that might be measured at highest and best use could also far exceed the operational value to an NPO. For instance, offices might be able to be converted into high-value residential accommodation and valued as such, but this use would not be within the purposes of an NPO. Measurement using a revaluation model may also raise questions of how depreciation should be charged and how impairment can be identified and measured, particularly where the overall value of an asset is increasing. Looking now at impairment, an annual impairment review is needed where there are indicators of impairment to assess whether an asset has a value lower than its carrying amount. This is required irrespective of whether the cost or revaluation model is used for subsequent measurement. Indicators of impairment might be because of an external event, like a flood or a regulatory limitation, or an internal event like lack of maintenance. An NPO may have difficulty in measuring the impairment as it may not have cash flow information which is typically used to estimate impairments. Where an NPO uses the revaluation model and is able to measure its value and use under that model, impairments are likely to be reflected through a deterioration in service potential. However, this may require significant judgments by NPO management and is likely to require experts to provide these measurements. And finally, there are financial reporting challenges associated with disclosure. It may be important to donors and other stakeholders to understand the operational capacity of assets when assessing the performance of particular services or activities to which they may have contributed. Where evaluation shows the operational capacity of an asset, it could allow users to understand the real cost of consuming the resources provided to deliver services by the assets, rather than what an MPO might have paid for them. However, where MPOs use the revaluation model, with values potentially fluctuating, it needs to be clear how the information provided in the valuations contribute to stewardship and accountability. MPOs will also need to explain the measurement basis it is using when disposing of assets. This will help users of the financial reports where this is material. Where an asset becomes surplus to requirements, the sale or disposal price may be materially different to the carrying value of the asset. Stakeholders will want to understand the difference between the economic value achieved on disposal and the value an MPO has derived from its use. So, having examined the difficulties in measuring non-financial assets held for social benefit that lead to financial reporting challenges for MPOs, we can now see what guidance is provided in international and national standards. There are a number of international standards for the measurement of tangible assets. For ease of examining these various standards, we can categorize them as either property, plant and equipment standards, fair value standards, or impairment standards. We will examine the requirements of each category in turn. All the property, plant and equipment standards require that assets are initially measured at cost. All of these standards, IAS 16, IPSAS 17 and the IFRS for SME standard, also offer entities the choice of subsequently measuring property, plant and equipment using either the cost model or at the revalued amount. They stipulate that this policy must be applied to the entire class of assets. The revaluation model under international standards requires entities to measure property, plant and equipment at fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. They require revaluations to be made with sufficient regularity to ensure that the carrying amount is not materially different from that which would be determined using fair value at the end of the reporting period. IFRS standards determine that assets measured at fair value must follow the measurement and disclosure requirements under IFRS 13 fair value measurement. Fair value is defined in IFRS 13 as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. For non-financial assets, IFRS 13 requires that assets are measured at highest and best use. IFRS 13 provides guidance on the techniques that are permitted by the standard, that is, the market approach, the cost approach, which would allow in certain circumstances for measurement at depreciated replacement cost, and the income approach. The IFRS for SME standard and IPSAS do not have a separate dedicated measurement standard or equivalent for fair value, and both use a different definition of fair value from full IFRS standards. IPSAS 17 establishes that the fair value of a property is usually determined by market-based evidence by appraisal. The IFRS for SME standard uses a hierarchy to estimate fair value based on market prices. Both the IASB and IPSASB have current projects that are considering the impact of IFRS 13. Under IPSAS 17, in cases where there is no market-based evidence of fair value because of the specialised nature of the asset, an entity may estimate fair value using the approaches of reproduction cost, depreciated replacement cost, restoration cost, or service units. An important part of understanding the value of an asset to a public sector entity is the concept of service potential. This is described in the IPSASB conceptual framework as the capacity to provide services that contribute to achieving the entity's objectives. The value in use measurement is more likely to reflect the value of services supported and thus its service potential for an entity. Within the IFRS standards, IAS 36, Impairment of Assets, requires that an assessment is made at the end of each reporting period where there is any indication that an asset may be impaired. It provides a list of indicators of impairment to assist with this assessment. If there is an indication that an asset may be impaired, then the asset's recoverable amount must be estimated. The recoverable amount is the higher of an asset's fair value, less cost of disposal, and its value in use. IPSASB has issued two standards on impairment: IPSAS 26, Impairment of Cash Generating Assets, which is based on IAS 36, and IPSAS 21, Impairment of Non-Cash Generating Assets, drafted for public sector circumstances. IPSAS 21 defines recoverable amount as the higher of a non-cash generating asset's fair value, less cost to sell, and its value in use, with value in use being the present value of the asset's remaining service potential. Having examined the guidance provided by international standards, we can now look at some national level approaches. National level guidance in the jurisdictions reviewed is consistent with either the IFRS standards or IPSASB requirements for initial recognition and measurement, subsequent measurement, and impairment. Jurisdictional level reporting requirements, therefore, depend on which of these frameworks has been adopted and any additional guidance or requirements introduced. One jurisdiction follows the IPSAS approach, but augments this with guidance on the estimation of fair value using the depreciated replacement cost method, which is frequently used by public benefit entities. Another jurisdiction does not permit the revaluation model, but follows IFRS standards for impairment as for commercial entities, but with one exception. Rather than establishing a non-cash flow focused recovery test to determine whether an item of property, plant and equipment is impaired, it discusses how contribution subsidies would be factored in to a cash flow focused test. Another jurisdiction generally follows the IFRS for SME standard initial and subsequent measurement requirements and is similar on impairment. This jurisdiction's standards do, though, specifically include the concept of service potential in the measurement of the value in use when measuring the recoverable amount of an asset. The consultation paper considers 4 alternative treatments based on national and international standards for the measurement of non-financial assets held for social benefit. The measurement of property, plant and equipment is consistent across standards regarding initial recognition, historical cost for assets purchased or constructed, and fair value for donated assets. These provisions therefore feature in all alternatives. There are, however, different approaches that can be taken to their subsequent measurement and impairment. The alternatives focus on these potential differences. Alternative 1 follows existing international standards, permitting either the cost or revaluation model for subsequent measurement. It includes additional guidance for MPOs, particularly on impairment. Alternative 2 follows existing international standards as Alternative 1, but permits the use of an additional measurement base, value in use, within the revaluation model. This would allow the concept of service potential available in the IPSAS to be applied to all classes of assets. Alternative 3 would not allow the revaluation model and would require all property, plant and equipment to be subsequently measured using the cost model. In this model, the fair value determined for donated assets would be used as a proxy for historical cost, which would be an amendment to all 3 international accounting frameworks. And Alternative 4 mandates the use of the revaluation model and a value in use measurement for land and buildings to ensure that the asset's measurement reflects the operational capacity rather than the financial capacity of the asset. This alternative uses the valuation approaches in IPSAS. All other classes of asset would retain the choice of cost or revaluation. This is your opportunity to shape the future by sharing your voice. Amongst a range of issues covered in the consultation paper, we want your views on the measurement of non-financial assets held for social benefit, including how the issue has been described, the alternative options that have been put forward, and the advantages and disadvantages articulated for each alternative option. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future, share your voice, submit your response.